Hey everyone, welcome back to Corporate Decoder. Today, St. Joe Company just filed its latest quarterly report, a 10Q, and I am seeing some record-breaking numbers that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. Their recent earnings show their best second quarter profit in 30 years. A truly impressive feat. Alright, let us dive into the heart of this filing, which is the financial picture for the St. Joe Company. They are a real estate development company, and their Q2 2026 numbers are quite telling. Looking at their balance sheet as of the 30th of June 2026, you can see they have total assets of about $1.5 billion. That is a solid figure, but it is slightly down from the end of 2025. On the other side, total liabilities are around $735 million. What is really interesting is their equity section. Their common stock, which is listed here, has a significant amount of authorized shares, but the number of outstanding shares is actually decreasing slightly over time. This could signal a few things, potentially share buybacks or maybe just careful management of share issuance. Now let us talk about the big story here, their net income. For the 3 months ending the 30th of June 2026, their net income attributable to the company was $40.5 million. That is a significant jump from $29.5 million in the same period last year. And for the 6-month period, it was $54.4 million in 2025. This is a strong performance. And as the news headlines point out, this is their best second quarter profit in 3 decades. Notice how their weighted average shares outstanding, both basic and diluted, have also slightly decreased from 2025 to 2026. This aligns with the increase in profit per S-share, meaning the profits are growing faster than the number of shares, which is generally a positive sign. Their total revenue is also up for the quarter. It hit $158.8 million, a 23% increase from the previous year. This is largely driven by their real estate segment, which saw a nearly 59% revenue increase in the quarter. Their hospitality segment also showed growth, reaching a record quarterly revenue. This hospitality revenue hit $74.2 million for the quarter, up from $68.8 million. The company highlights strong performance in club memberships and hotel operations with higher average daily rates and occupancy. When we look at their real estate assets, the investment in real estate net is around $990 million. This is their largest asset category, showing their core business is firmly rooted in property. The company is actively involved in joint ventures, or JVS. For developing real estate, they have several consolidated JVS, like the Mexico Beach Crossings JV and the Lodge 30 JV, where they hold majority stakes and have control. This is a strategic move to spread risk and leverage expertise. They also have unconsolidated JVS where they account for their investment using the equity method. The Latitude Margaritaville Watersound JV is a big one here, with the company holding a 50% stake, while they are not the primary beneficiary in some of these unconsolidated JVS. Their investment still represents a significant asset, totaling over $70 million. Looking at their debt, it stands at about $370 million. This is a manageable amount relative to their assets and revenue. They also have a significant amount of long-term debt, with maturities stretching out for many years. The company notes that most of their variable rate debt is either fixed or hedged with interest rate swaps, which helps manage risk from rising interest rates. A notable point in their financials is the stock repurchase program. In the second quarter of 2026, they repurchased nearly 500,000 shares of their common stock for about $32.7 million. This shows a commitment to returning value to shareholders, especially when profits are strong. You will also see accumulated other comprehensive income, which represents unrealized gains or losses on certain financial instruments. For St. Joe, this figure is relatively small, showing that their main business is not heavily exposed to these types of fluctuations. Their depreciation, depletion, and amortization expense is around $22.8 million for the 6 months. This is a non-cash expense that reflects the cost of using their assets over time. It is important to note this is a significant expense, but it is a normal part of a real estate and hospitality business. Their income tax expense is also substantial, around $18.6 million for the 6 months. This reflects the profitability of the company. Their effective tax rate is a bit higher than the statutory rate, mainly due to state income taxes. Digging into their segment performance, the residential segment is a major revenue driver, accounting for over 33% of quarterly revenue. Hospitality is also very strong at nearly 50%, and commercial makes up about 13%. This diversification is a key strength. The company is seeing strong growth in real estate revenue, up nearly 59% in the quarter. This is fueled by an increase in homesite sales and also includes some significant unimproved land sales, which can create lumpy revenue but are often high margin. The hospitality segment is also performing well, with revenue up nearly 8% in the quarter. They are seeing improvements in ADR occupancy and guest spending. The Watersound Club is a significant contributor here, with membership numbers steadily increasing. Leasing revenue has seen a dip, largely due to the sale of a senior living community. However, they are seeing some offset from new commercial property leases. Corporate and other operating expenses have increased, largely due to higher employee costs and owner association assessments. This is something to keep an eye on, but it seems manageable given the overall revenue growth. Their equity and income from unconsolidated joint ventures has decreased, mainly due to fewer home sales at the Latitude Margaritaville Watersound JV. This highlights the cyclical nature of some of their partnerships. Looking at their capital expenditures, they invested about $44.7 million in the first half of 2026. This is a significant investment in their future growth, particularly in their commercial and hospitality segments. Net cash provided by operating activities is strong, at $86.2 million for the first 6 months of 2026, up from $60.1 million in the prior year. This indicates healthy operational performance. Financing activities show significant outflows primarily due to stock repurchases and dividend payments, which is consistent with their strategy of returning capital to shareholders. Now, like all companies, St. Joe includes forward-looking statements. They are talking about continuing to focus on real estate development, growing hospitality, and expanding commercial properties. They believe their current financial position and land assets will support this for years to come. However, they also list a number of risks. They are exposed to interest rate fluctuations, inflation, higher insurance costs, and the potential impact of geopolitical conflicts. Their dependence on home builders and the cyclical nature of the real estate market are also key risks. The fact that they are concentrated in Northwest Florida is also mentioned as a risk, though they believe the region's growth offsets this. So, what is my take on all of this? St. Joe is showing some truly impressive financial results with record profits and growing revenue, their diversified business model across residential hospitality. And commercial segment seems to be working well, and their strategic use of joint ventures allows them to expand without taking on all the risk. The stock buybacks and dividend payments signal confidence from management. However, the company is not without risks. The real estate market can be cyclical, and economic headwinds like inflation and interest rate hikes could impact future performance. The concentration in one geographic area also presents a unique risk. What I am actually looking for is how they manage their increasing debt levels and sustain these strong margins in their hospitality segment going forward. Alright, that is my take. Stay decoded. If you appreciate getting straight insights from corporate documents, make sure you are subscribed and hit that like button. The research tools I use are linked in the description. They help keep this channel going.